Hey, I'm Hervin Pesa, I'm a financial planner, and in this video, I'll go over the key tax and financial planning updates you need to know about for 2023. These changes could help you save money in taxes and direct more of your hard-earned dollars into your own goals. Whether that's for your retirement, saving for a home, or providing for your family. Because this video is designed to go over as many of the changes as possible, I'll point you to other videos or resources that we've put together in the past, since some of these topics can become fairly complex and would require some further explanation. I'll go over the new tax brackets for 2023, RRSP and TFSA updates, a new tax credit, and some business planning credits that you need to understand, and the new FHSA, the account that's designed to help home buyers get into their first home. There's also the opposite of that, which is the anti-flipping rules that are designed to make profits from real estate speculation more difficult to come by. I expect this video to be a little bit longer and meatier, so skip to the sections that you feel are more relevant to you. But if you're new to personal finance, you're new to learning about how money matters work, stick to the very end because I go over additional resources that should help you further your understanding. This is not designed to help you learn how taxes are calculated. I already have a deep dive video going over how taxes are calculated here. So if you want to learn more about that, set aside a few minutes and really invest some time into watching that video. It'll be worth it so that you can really understand how you can set up your own affairs to maximize the tax benefits available to all of us. Inflation and indexation. For the most part, tax-related calculations and figures are scheduled to be indexed annually or adjusted to inflation on a yearly basis. This is intended to allow taxes to keep up with the times. Now, how we earn and how we spend money is always changing, and this is designed to account for that. The main benchmark used to make these adjustments is the CPI, the Consumer Price Index. That's the key indicator that we track for inflation. We'll reserve our conversation about its accuracy for a later topic. But if the CPI growth, for example, is at 2%, then the tax brackets and the key figures for tax calculations also get increased by 2%. Maybe you haven't noticed or felt it, but you can now earn more income and pay less tax over time. Look back to 2012. The lowest marginal tax rate was 15%, and that applied to up to $42,707. 10 years later, in 2022, the first tax bracket caps out at $50,197. So you earn $7,490 more and still pay the same 15% in taxes. For 2023, the increase for CPI that we're using is 6.3%. So you'll notice that the tax brackets will also increase by that much this year. The Canadian tax system is calculated based on a marginal tax rate. This means you have different tax rates for every bucket or tranche of income you earn. I'm not sure what province you're based out of, so we'll strictly look at the federal level. There are 5 official tax brackets: 15%, 20.5%, 26%, 29.32%, and 33%. The tax rates stay the same for 2023. However, the buckets have been adjusted upwards. This should happen every year. The first bracket of 15% is now applied up to $53,359 of income. That's up from $50,197 in 2022. The second tax bracket is between $53,360 all the way to $106,717. That's also higher. In 2022, it was at $50,198 all the way to $100,392. The third tax bracket is income over $106,717 all the way to $165,430. This is up from last year, where it started from $100,392 all the way to $155,625. The fourth tax bracket is $165,430 all the way to $235,675. Again, this is up from last year, where the bracket started from $155,625 all the way to $221,708. The fifth bracket is any income above $235,675. Now, however, the main takeaway is that if your income stayed the same, you should pay less in taxes. The thresholds have increased, your provincial tax brackets would have also been adjusted upwards. So you could have earned a little bit more in 2023 and pay less compared to 2022. Earlier, I said that there are officially 5 tax brackets. However, there is a 6th. I call it the tax-free bracket. This is because up to a certain level, you can fully eliminate income through the basic personal amount. In 2023, the basic personal amount is at exactly $15,000. This means that any income up to that $15,000 threshold is tax-free, 0 taxes. This is up from $14,398 in 2022. That in itself is good information to know, but how can you take further advantage of that? If you have children or family members that work for you and your business, maybe as part-time employees or as seasonal employees, you can pay them a fair wage and they won't have to pay any taxes as long as their income does not exceed $15,000. This is an effective way to split income. This $15,000 limit is the enhanced total, which combines the basic minimum amount of $13,521 plus the additional PBA of $14,799. This additional personal basic allowance is reduced once your income gets into the 4th bracket, and it slowly gets reduced as your income increases until you hit the 33% tax rate, at which point that fully eliminates the PBA. Let's talk about the tax-free savings account. If you haven't topped up your TFSA this year yet, this is your reminder. The TFSA, or the tax-free savings account, is still one of the most underutilized savings tools we have. Any growth inside of the TFSA is tax-free, and the withdrawal, 100% tax-free. No catch. The only limitation to the TFSA is its small contribution room. However, as long as you are 18 and above, you will be entitled to additional contribution rooms every single year. This means every January 1st, you will receive additional TFSA room. For 2023, that amount is $6,500, which is up from the $6,000 contribution room we got in 2022. Now, this is the first time we've had an increase since 2019. This is because the TFSA is indexed to inflation annually, but it is triggered in $500 thresholds. Remember that the TFSA is based on residency and not on citizenship. You do not have to be a permanent resident or a citizen to qualify for the TFSA. All you need to have is a valid SIN number to be over 18 and live here. The TFSA room accumulates the year you move. Even if you haven't filed taxes yet, it has no proration. So if you've moved to Canada at some point in 2022, you will have the $6,000 in room from 2022 plus the new $6,500 we have available to us in 2023. I also made a TFSA room estimator available for your convenience in my site. However, the easiest and most accurate way to look into your TFSA if you've been filing taxes for a while is accessing My CRA, and you can see your TFSA room through that. Let's look at the RRSP, or the Registered Retirement Savings Plan. This allows you to save money in taxes in multiple ways. First is the tax deduction you get when you make RRSP contributions. Second, all the growth that happens inside the RRSP is tax deferred until you withdraw. Now, you do get taxed as you make your withdrawal. However, this is another benefit that's often misunderstood. If you make contributions in a high tax rate, let's say 29.32%, you save 29.32% in taxes when you make that contribution. When you retire, you would likely need less compared to your current income, thereby paying less in taxes. Here's one thing to consider. With proper planning, you can also expect to have more flexibility on how you draw your income in retirement. You have additional tax breaks that you can take advantage of to reduce your taxable income. So what matters is the average effective tax rate that you'll pay in retirement. If your average tax rate at that time is 20%, you'll pocket the 9% difference. Please understand that you can also make RRSP contributions up to 60 days of year end, and it'll still count towards the previous year. In this case, the last day that you can make contributions to count for 2022 is March 1st of 2023. One side note here. Just because you made contributions does not mean you need to declare those deductions this year. You can carry those deductions forward if it's more advantageous to you. If you expect your income to actually increase in the coming years, or you want to use this as a retirement planning strategy, delaying using those deductions into your 60s so that you can use that to offset and to lower your earned income or your net income in retirement, that could potentially give you additional advantages for OS clawbacks, for example, or other income tested benefits. RRSP contribution rooms are based on earned income, so your salaries, net rental income, and business income if you're a sole proprietor. You multiply that earned income by 18% up to the dollar limit. In 2022, that dollar limit was $29,210. That has been increased to $30,780 for 2023. So let's look at two examples. If your earned income was $120,000 last year, your additional contribution room for 2023 would be $21,000. However, if you earned $180,000, your additional contribution room will hit the ceiling at $30,780, not $32,000. Let's quickly talk about payroll deductions. As an employee, employment insurance and CPP are automatically deducted from your paycheck. EI premiums increased in 2023 to 1.63%. That's 1.63% of every dollar you earn until you hit the maximum insurable earnings threshold. This is the MEI. This is up from 1.58% last year. The MEI is also increasing from $60,300 to $61,500. This may feel like just more tax to you until you have to claim employment insurance. Then at that point, a lot of people say it's not enough. After you hit that $61,500 in income, you are no longer paying for EI. So regardless of your annual income, this is where your premiums stop. And that's also where the benefit calculations are capped. EI is intended to cover 55% of the average weekly insurable earnings, which is $650 per week. That's why it might feel small when you actually need to claim. You only paid premiums up to that threshold. Now, I'm not really sure if this audience would like a deep dive into EI, so if you want to know more about it, hit us in the comments below. The CPP. The Canada Pension Plan is one of the biggest pension plans in the world. It's designed to help Canadians achieve their goal of a safe, secure, and dignified retirement. That's straight from the government website. Now, for January of 2023, the maximum CPP is $1,306.57 or $15,678.84 every year. The Canada Pension Plan is in the middle of a series of enhancements designed to increase the CPP's income replacement factor. The CPP was first intended to replace 1/4 of your pre-retirement income. The enhancement will be designed to bring this up to 1/3 of your pre-retirement income. So since 2019, the required CPP contributions have increased gradually in order to facilitate for this goal. This year, anyone who is over 18 and earns at least $3,500 will contribute 5.95% of their income until the maximum pensionable earnings of $66,600. At that point, you will hit the maximum contribution amount of $3,754.45. Your employer then matches this contribution, bringing the total CPP contributions on your behalf to $7,500 roughly. If you are self-employed or you run your own business, you are responsible for the entire $7,508.90 or 11.9% if your income is less than YMPE. If you are an incorporated business owner who only pays yourself dividends, you're not earning any pensionable income. Therefore, you won't have to pay any CPP premiums on those dividends. This becomes a common question for us. Now, a lot of clients come to us asking for advice and their accountants for advice. Do I draw purely dividends or do I pay myself salary? There's no cut and dry answer to this. However, be sure to ask your financial planner and look into your own scenario and look at what's best for you because it can get quite complex. This analysis is included in our fee-for-service plan for business owners. So if you don't have a trusted advisor, you may need to look at a team of people to look at what makes sense for you. Reach out to us. I also have a series of videos dedicated to CPP, when to take it, whether you want to take it early or later, or splitting it with your spouse. There's also the CPP disability and the survivor benefits. Check that out in our channel. Old age security. From January to March of 2023, the new maximum for OAS for those that are age 65 to 74 is $687.56 per month, or $8,250.72 every year. If you are 75 or older, that's bumped up by 10% to $756.32. These numbers are adjusted quarterly. So if you're watching this video after March, check the links in the description to get the updated numbers. Unlike the Canada Pension Plan, the OAS is not based on your contribution, but it's taken from the general tax pool. Because it's a form of social security, it's not really designed to provide for those who already have the means, those who are already capable of providing well for themselves in retirement. The OAS benefit is reduced or clawed back after your income goes beyond a certain threshold. For 2023, the OAS clawback threshold is $86,912. That's up from $81,761 in 2022. This means anyone earning an income above $86,912 will be subject to a 15% recovery tax, which will then reduce your benefits in 2024. For more information about the OAS, we have a series dedicated to that as well. The basics, the clawback, as well as taking it at the right time, whether that's at 65 or taking it later. Watch those videos, it might just save you thousands of dollars. The GIS, or the Guaranteed Income Supplement, is a social benefit designed to help low-income families in retirement. You must qualify for OAS to get considered for the GIS. The benefits vary depending on your marital status and the OAS access of your partner. These are income tested, so benefits are reduced and are eventually eliminated once you hit the threshold depending on your family situation. The updated thresholds for 2023 are as follows. So once you hit these numbers, you are no longer eligible for GIS. So if your income is below these numbers, there's a link in the video walking you through the schedule on how much you can expect for GIS this coming year. So if your income is below $20,832 as a single, widowed, or divorced individual, you will still have OAS. If you have a spouse or a common law partner, the thresholds change depending on their OAS access. First is if they also have the full OAS pension, your combined income must be less than $27,552. If your spouse or common law partner does not receive OAS pension, your income must be below $49,922. If your common law partner has access to the allowance, your combined income must be below $38,592. The blog will include a link to the GIS tables that will give you your anticipated GIS benefits if your income falls below those thresholds in 2022. The First Home Savings Account is a registered account launching in April 1st this year. Not to be confused with the First Home Buyer's Plan that allows you to use RRSP funds as your down payment. This is totally different. In 2022, we saw the fastest climb in real estate values in many generations, making home ownership more difficult for many who already feel like they're trapped in a rental hamster wheel. But here's the thing, even before 2022, housing has been a hot topic for many. A lot of people calling it a housing crisis. The First Home Savings Account is designed to help alleviate that, making home ownership more accessible by providing incentives to save for the down payment. It'll allow you to make an $8,000 contribution every year that is tax deductible up to a $40,000 limit. This lowers your taxable income while you're making contributions, just like the RRSP. Then, when you withdraw, it is 100% tax-free as long as you make and you meet the eligibility criteria. It combines the best of the RRSP and the TFSA, as long as you use these funds for buying your home. So far, the eligibility seems very similar to the home buyer's plan. For you to be able to open an account, you cannot have owned a property that you've lived in this current year and the 4 preceding years. This is still new and warrants more information, so be sure to follow our page and subscribe to get more information. I'm already working on a video tackling the planning scenarios around this, not just the basics. Now let's look at the opposite of that, which is the anti-flipping rules. Ordinarily, when you sell your home, you would be eligible for the principal residence exemption. This means any growth in your property would be tax-free once you sell it, regardless of the amount. This gives home ownership a massive advantage in wealth building, as well as intergenerational wealth planning. However, some people use this as a way to speculate on property values as they buy their home. They buy a home, they live in it, renovate it, flip it for profit. This becomes tax-free income. This is one of those speculative tax plays that the CRA aims to close this year. So if you sell your home within 12 months of purchase, the CRA will disallow the primary residence exemption, and it will add the full gain as business income. Therefore, this loses any preferential treatment available to capital gains. Essentially, it's 100% taxable minus any deductions that you can justify against it. Now, the same treatment will also apply for assignments, so selling the right to purchase a property. The government is really trying to tackle housing affordability. This is one of those measures that gets politicized. Whether this works or not is still left to be seen. I, for one, think it makes sense. I just don't believe that there were really enough of these transactions to cause the prices to swing in either direction. What do you think? Let me know in the comments if you think this is one of those effective methods to cool down housing prices. The LCGE, or the Lifetime Capital Gains Exemption, is one of the biggest incentives that is in the tax code to incentivize people to start, run, and grow a business in Canada. The capital gains exemption is probably the biggest benefit, honestly, for business owners. If you sell shares of a qualified small business, you can shelter a significant portion of the gain. In 2023, the LCGE is at $971,190. This is up by $57,560. What this means is that you can start a business from scratch, work insanely hard, grow it, and sell it for a gain up to $971,190, and it would be tax-free. However, at the time of sale, your business must meet the qualifications that shows that it is active and it qualifies as a small business. This purification process requires advanced planning. Otherwise, your business could be disqualified from LCGE at the time of sale. So this is one of those things that you need to keep an eye on if you're intending to sell your business in the next few years. You cannot have too many passive assets inside it. It still needs to be deemed as an active small business. Be sure to consult with your CPA if you're intending on selling your business. You want to make sure that you can use the LCGE to the best of your ability. It's designed as one of the rewards for working so hard to grow your business. Next, we have the multi-generational home renovation tax credit. Beginning January 1st this year, we have a new credit designed to help individuals who have to create secondary dwellings in their primary residence in order to care for a family member who is a senior, so somebody that's over 65, or an adult that has a disability. The credit is for 15% of eligible expenses up to a maximum of $50,000, giving this benefit a total value of $7,500 if you can maximize it. This particular credit is one that I need to look into further because this could potentially apply to me. We're building a secondary unit in our primary residence, and it's there to host family members. My in-laws, we want them to live with us so that we can take care of them, but at the same time, give them their own space. So highlight this if this is a scenario that may apply to you. We will create further resources and further videos on this. One thing that I want to show you though, and want to highlight, is that this is not the same as the home accessibility tax credit. That one is designed to help qualifying individuals make their homes more accessible for mobility reasons. So think of it as renovations that are not necessarily designed to add value, but are designed to add access for you or your family members as they get into their old age, or to help them adjust for their disability. That's totally different. Let me conclude by saying that your tax plan and your financial plan is on a range of complexity. I am a financial advisor, however, I'm not your advisor. I hope that you use this as a resource, as a conversation piece between you and your advisor, and that you can gain some ideas that save you some tax dollars and avoid costly financial mistakes. If you're ramping up into retirement within 10 years, certainly within 5 years, be sure to take advantage of our complimentary values call. It'll help you understand how you can retire successfully, and if it's a fit, you can learn about our fee-for-service retirement income plan. If you're not ready to take that step, watch this video here because it'll walk you through what you need to consider when you're planning for your retirement and answer some of the questions that you may have. Maybe you're thinking to yourself, just how much do you really need to retire? There's a lot of things that go into it, so I prepared this video going along with multiple case studies. I hope to see you there. If this video was helpful to you at all, please react to it in any way you can. Give us a thumbs up. Leave us a comment, actually. I would love to know where in Canada you're watching this video from. Follow me on my LinkedIn. Subscribe to our channel. Follow my Facebook page. Follow me on Instagram. All the social stuff. Still learning about this. I appreciate you watching if you've made it this far. Video's done though. You can move on to the next one. Come on. See ya.